Hello everyone, we are FinTech FYP Group G and our topic is leverage investment under trading costs. Our research direction is regarding the application of discrete Morton problem on optimal fraction result and adjustment period. We will start with some basic introductions, which includes motivation and objectives, and then some of the background theories and foundation we use for our project. Next, we will briefly talk about our model construction, parameters, simulations, and the conclusion. Our main purpose of this project is to discuss the Mertens problem. Given the weld process with an estimated control pi and the utility function, the optimal pi can be solved explicitly, which is independent of time. These are our motivations on why we would further extend the Mertens problem. To start with, the theoretical concepts of Mertens problem have these three following points. First, it does not include loss function in the model. The model itself assumes that market do not have transaction and other related costs. The second is the assumption of continuous time, which means that trading would be executed instantaneously. Third, this can be applied broadly to different risk appetited investors since it has a risk aversion gamma in the explicit solution. However, in the actual market scenario, we would identify different points. First, the real market has different friction costs such as transaction fee, tax fee, and so on. Therefore, we further include loss function in our simulation. Secondly, real market could not trade simultaneously. Trade would take anywhere between seconds to hours to complete depending on the markets. Therefore, we try discrete Mertens problem in our simulation. Moreover, since the application of Mertens problem is really broad, we use S&P 500 sectors and different countries' historical data to do simulation and analyze. Our objective of this project are these three things: to find the optimal fraction, to find the optimal adjustment period under both frictionless model and friction model. We use three main foundation theories for our simulations. First is the geometric Brownian motion, which is basically a stochastic model with the underlying factor that it is continuous and follows Brownian motion. The mean value of historical return of stock is determinant for the mean of stock price, while the volatility affects the interval of the distribution. These two factors hand in hand will affect the outlines of the distribution graph and its shift. In general, the distribution will be a factor of the normal distribution. Secondly, we will assume the investor's utility will follow the power utility function. Utility function is a measure of satisfaction and their preference for a certain choice and try to make a numerical value comparison between the preference of an individual towards the choice. Thirdly, we have Monte Carlo methods, which is also one of the most frequently used simulation methods to estimate parameters. Now we could start to construct our model, for which we use these three main functions, which are the solution of Mertens problem, GBM, and utility function. The following figure represents the flowchart of the program for Mertens discrete problem that will be the base model used for the simulations. The program will start with initializing the parameters, then we would use GBM pricing formula to forecast the stock paths. We would then initialize the mean return of the stock and risk averseness to calculate our optimal fraction from the Mertens problem. We should take into consideration that there is a transaction cost if we are in a friction condition. We will then find the final weld of each stock price and utility, and then we would average the final utility and find the forecasted utility. We would store the final utility and compare the utility of each step. Next, we will estimate the parameters of the Mertens portfolio problem using historical data. Four main parameters need to be estimated in this model, and they are return, standard deviation, risk aversion gamma, and loss function lambda. This is the flowchart of our estimation of expected return and standard deviation. We use daily return to get annualized return and standard deviation. This following table is the simple summary of the numerical value of the risk aversion that we got from the Federal Reserve Bank. Next, we have the loss lambda function, for which we use 1% loss function based on the data accessed from Citibank for the implementation of this project because we believe that it represents a global reach and is thus fitting for our project. Next, we have summarized the parameters of the different sectors for the S&P 500. The risk aversion and the risk-free is fixed in these data since we used US risk-free rate and US investor risk averseness because we believe that it will be fitting to sample for an American investor as this index is a US-based one. Here we have a summary of parameters of different countries and cities for our simulation. We further make the risk-free rate and gamma according to the 1-year treasury and the risk aversion data as fitting with the country. After all the parameters are decided, we now continue to discuss about the simulation. The numerical simulation results are listed here. There are two money accounts, money market account and stock account. We will get an optimal fraction to identify initially how much money we would invest in, and later price flow will follow GBM as discussed previously. The graph simulation results would start with the result of how far apart in 1 year span we should rebalance our portfolio to maximize the utility based on a 1-year time horizon. The curve should look like a concave curve since the utility will increase at first, then we do some rebalancing, but the utility will decrease here due to high transaction costs. After further research, we have also improved our model to make a more intuitive model because the previous curve was not smooth for the simulation. There are two major improvements for our model. Instead of counting the days from rebalancing to another, we use time/frequency of rebalancing to group the data better. Second, we further included a calculation of the probability of bankruptcy to observe the data. To start with, we are going to first discuss the frictionless model of sector analysis. We use the information technology sector of the S&P 500 as an example here. As we can observe from the graph, there is a generally upward trend in the graph, indicating that doing adjustment as much as one can would have a positive impact on the investor's utility, and the probability of bankruptcy will generally remain zero. We further verify this result for most of the GICS sectors, since most of them have a good performance under the 10-year horizon. After obtaining some insights from the frictionless model, we are going to further extend our model to a friction model that includes the transaction cost. We would start with the best perform in return among all sector, which is the information technology sector. We obtained an optimal fraction of 4.55 and we obtained an optimal adjustment number of 12. These two numbers are large when comparing to other sectors since this sector has the best performance. However, the probability of bankruptcy is not zero given that the fraction itself is still dangerous. We are going to now do some simulations for the past historical data for these countries and cities to conclude how different economic systems will affect the simulation. We would like to start with the frictionless model again. We use Hang Seng Index as our example, and we could see from the graph that the result is a little bit strange. Unlike the previous sector frictionless model, we generate a rather zigzag figure. As we observe the y-axis of the figure, the range of the utility is a small difference we could ignore. The results did not differ for different simulations. We conclude that since the fraction of Hang Seng Index is too small that the investor invests a lot of wealth into the risk-free rate, the utility does not differ a lot under our simulations. Therefore, the result is mainly dominant by the random seed. These are some examples of how different macro factors could affect the performance. As we can see from this example, the performance of IDX is really bad from the historical data, thus the optimal adjustment fraction is negative, indicating we would need to short sell. Meanwhile, for cost pi, since the risk aversion of Korea people is really low, the adjustment fraction is pretty high. Finally, as a conclusion of our model, the simulation results indicated three main conclusions. First, good performance leads to larger fraction, which means higher return together with lower standard deviation would increase the optimal fraction. Secondly, the result is more varied on our countries and cities analysis since there are more variables we need to consider. Last but not the least, following the result of Merton's problem is indicated to be a pretty good investment strategy since we could still invest in risk-free asset if the risky indices have bad performance according to the investor's risk aversion and also the ability to adjust depending on the risk appetite of each investor. And finally, I would like to thank you for watching this video till this far.